Hello and welcome to Sunstone Eduversity's yet another Sunstone Trial Class. Today we have a very interesting topic to discuss. Today's topic is Finance Basics, Corporate Finance, and this is Sunstone Eduversity's sixth trial class. Sunstone Eduversity is India's only pay-after-placement MBA PGDM program. We partner with 9 leading campuses of the country at different locations. Sunstone Eduversity takes full accountability of students' careers and reduces the financial burden of paying such a high fee for a management program. Today, we will be discussing finance basics, corporate finance. In today's session, we will learn what these terms, capital budgeting, capital structure, and working capital mean and how to value them to make constructive decisions in a very brief way. Bipin Thakur is here with us. Bipin is a finance faculty at Sunstone Eduversity. Hi, Bipin.
Hi, Amit.
Hi. So talking a little about Bipin. Bipin is a finance professor and alumna of IIM Calcutta. He owns his own enterprise and has worked with MNCs like Yes Bank, Standard Chartered, to name a few, in helping them with tax management. He also has raised funds for various promising startups. It's a pleasure to host you again, Bipin.
Okay, thanks again. Yes.
So should we begin with the trial class?
Yeah, sure. Thank you.
Sure.
My pleasure.
Sure. Okay.
Yes. Yes, today I'm Bipin, and today we will be taking the concept about corporate finance and why do we study corporate finance and what are the basic elements of corporate finance and what are the basic further how to make decisions using the corporate finance topics. So let's start. First of all, we need to understand what you mean by corporate and what are the objectives of before doing the corporate finance and all. Now, when we talk about corporate, we need to get back to the Companies Act. So all the organization and entities which fall under the category of Companies Act 2013, they come under the corporate finance. Let's say, for example, private limited company, when we talk about a limited company or an LLP, they falls under the corporate finance. So what are the primary objectives? How do we make decisions? So whenever we talk about a company, basically we have to take 3 kinds of decisions. So we have to understand about what is a long-term investment decisions, what is long-term investment decisions, also known as capital budgeting, and what are the factors affecting capital budgeting. How do we take working capital decision? That is a short-term investment decision. And what are the factors which affect short-term working capital decision? And a concept of capital structure, like how much equity should be raised, how much funds shall be raised from the outsiders, that is from debt source. Factors affecting the capital structure. Next, we can see the objective of corporate finance. It is to maximize the shareholders' wealth, because shareholders are the real owners of the company. We are working for them. So we need to maximize the shareholders' wealth. How can we do that? So that we can do by increasing the market price of the share. And that is being done by the decision taken by the CFO of a company. So we can see shareholders maximization is possible by ensuring sufficient funds at the reasonable cost. For example, when we are talking about ensuring reasonable fund, it means that we need to raise the fund from equity or debt. That will be studying detail in capital structure. Now, ensuring effective utilization of funds, that is how much of the fund is to be invested in the long-term investment thing, and how much is to be invested in the short-term investment thing, and such that we should have the maximum return. And ensuring safety of funds. How come? There are 2 kinds of companies. You must have come across many companies. There are certain companies who shares their profit, that they give dividend to their shareholders. There are certain companies who do not give dividend to the shareholders. Many people who are not aware about core corporate finance, They become very annoyed when some company does not give dividend. But why will they give you dividend? Try to understand. Let's say if they are investing your money, if the company is growing with the company's ROI, return on investment, is greater than what you will be doing, like what can you do with your money? You can just put your money in the bank's FD, that is the risk-free investment. And what is the bank FD rate going on? Right now we have 5 to 6% rate. So if you talk about that, so 5 to 6%, but a company is growing at 20% of like ROI. Company's ROI is 20%. So you can understand about how can we look over that? Like for example, if you are investing, you are getting 6%, and company is getting back, company is getting back around like 20%. So it is better for company to not to give dividend and reinvest it in the company for the further expansion, for the diversification of the current company. So we can see next one. Important decision in the corporate finance. Now, who takes the decision? You might have been aware about this word called CFO, Chief Financial Officer. So he has to take major three decisions. That is investment. Investment can be further classified into capital budgeting decision, working capital decision. Third, dividend decision I discussed about, and financing decision. Now we can see investment decisions. So it relates how firm funds are invested in different assets so that firm is able to earn highest possible returns on the investment. So how do we invest? Like you have two options: invest in project A, invest in project B. So you need to do certain analysis using various capital budgeting techniques, which we'll study in the further class. And if the result comes favorable, then we go for project A, or otherwise if we go for project B. There are two kinds of situation: accept, reject, and mutual exclusive situation. Let's say if you have only one project, then there should be certain management criteria. Like let's say management wants to earn 20% return, and the the internal rate of return, they can generate only 15%. It means that like we should reject the project because it is not fulfilling the management criteria. But we are having two machines, that is called mutually exclusive case. So in case of two machines, select the project having highest return. We can see like investment decision, long-term decision we have discussed, short-term decisions we have discussed. Now examples of long-term decision, like investment in land and building. So whenever we are talking about capital budgeting decision, why do we talk about, like, these are the capital budgeting decision: investing in plant and machinery, investment in launching a new product, opening a new office. These are all capital budgeting decisions. Now capital budgeting decision, you can see that it involves committing the finance on a long-term basis of fixed asset on various projects of an organization. So we need to understand it involves huge amount of investment. Whenever we are going to buy a building or plant and machinery, we might have to invest 2 CR, 3 CR. So that's very high investment. And these are irreversible decisions. We cannot look back again. That's why we need to analyze the decision very nicely, because it might affect our long-term profitability as well. So purchase of new fixed assets, land and building, opening a new branch, launching a new product line, investing in advanced techniques, major expenditure in advertising campaign, or research and development program. These are the example of capital budget decisions, because huge funds are involved. It affects our long-term finance, long-term profitability also. I cannot change. Let's say, for example, you might have taken many decisions in your personal life as well. Buying a home. You cannot change your home every time. If you don't like now buying a new car, after 2 days, you can't say that you don't like a car. While selecting a car, you look upon various factors. Similarly, we look into various factors while buying a plant and machinery. Because taking a wrong machinery, it would reduce our production, hence further affecting our future profits. Why it is so important? I told you recently, Abhi, long-term effects on profitability and growth competitiveness in the long run. Large amount is blocked in the long-term growth. If you take any machinery, let's say what you bought a car in your life, we don't buy car on every year basis. We buy it on a for 5 years or 6 years, maybe once in a 5 and 6 years. Similar goes with the companies. They don't buy machinery and they don't buy a building every day. So they have to take the decision very cautiously. Now, risk involved. Since huge funds are involved, there is a very high risk. Might be if our project fail, so our amount might get into that amount might get like it blocked into the amount. So business risk is very high. Irreversible decision we have discussed previously again. This decision taken once cannot be abandoned without incurring a heavy losses. If my business did not work, now we have a very heavy loss. What are the factors affecting capital budget? The rate of return of the project I discussed. If we have mutually exclusive case, we have two machines ka case, two project ka case, select the machine having higher cases, higher return. Cash flows of the project. Now try to select, like, there are different people. Some people thought about return. Some people think about recovering their investment. I might also think about it. So if I buy any product, I think about in how many years I will recover my investment. That is called payback period. So if your cash flow is good, definitely your payback will be lower, and hence you can recover your investment very easily. Some people goes with the cash flow also. Investment criteria. Now this is a technical. Let's go over the technical thing. So we have two kind of techniques. One is one where we consider time value of money. Somewhere we don't consider time value of money. There are certain traditional techniques like accounting rate of return. There are traditional techniques like payback period I discussed above, and there are certain non-technical, non-traditional method where we consider time value like net present value, like internal rate of return, modified rate of internal rate of return, profitability index, and discounted payback. So by applying these techniques, we try to find a favorable result. If we're having a favorable result, we go for the project. Otherwise, we may reject the project. Now, next we can see working capital decision. This is a short term. And basically, if someone asks me what is working capital, so I'll talk about that portion of a capital investment which is invested in current assets. What is current assets? Anything which can be converted into cash within a year or an operating cycle, which we'll discuss right now. So it is also known as short-term capital, circulating capital also. This decision affect day-to-day working of business. How come? Because on daily basis, I need to pay certain amount of cash. I need to clear certain claims. And similarly, I receive certain amount of money. So we have what? We receive some amount of money, we have to pay some amount of money, and the difference is called working capital. Broadly, we have two concepts of working capital, which we'll discuss right now. So it affects liquidity as well as profitability of the business, because the short-term assets are more liquid but more profitable. I'll give you one example. You have a big office. You have all kind of assets, what you want, how to run a company, everything. But tell me, if you will not manufacture goods, how can you earn profit? So to manufacture goods, you have to invest in the inventories. That might be in the raw material, work in progress, or conversion of raw material to finished goods. So you need to invest your money over there. So try to understand, if you don't invest your money in the working capital, you cannot earn very high profit. So that's why it is very profitable. Efficient cash management. What are the part of current assets? Working capital is equal to current assets. Who are current? What are current assets? They are cash, cash at bank, inventory, receivables. So further, working capital can be segregated into different parts. One of them is cash management, inventory management, receivables management. These are essential ingredients of a sound working capital management. Now, need of working capital, we can see here. Working capital is needed because of operating cycle. Now, what is operating cycle? I invest my money in buying the raw material, and that raw material get converted into half done product, that is called work in progress, WIP. And that WIP is reconverted to finished goods. Now, finished good is what I am going to sell to my consumers. Now, from the finished goods, I sell it to, I have two options. Either I can sell my finished goods, to your on cash or credit. That we can see here. So let's say what if I can sell my finished goods on credit, so that can get converted into receivable. Now from receivable will get converted into cash. Now receivable will be converted into cash. So the conversion of cash to cash is the operating cycle. Larger the operating cycle, more is the working capital. Lower the operating cycle, less is the working capital requirement. So gross is only the current assets. When we talk about net working capital, that is current assets minus current liabilities. What are current liabilities? We can see. So those claims to outsider which are expected to mature within an operating cycle or within a year. Example, trade creditors, bills payable, outstanding expenses, to employees, bank overdraft. Now, net working capital can be positive or negative. If it is positive, we don't require short-term loan. If it is negative, we definitely require short-term loan. And short-term loan is called bank overdraft or your cash credit. We need to take a cash credit from the bank or a bank overdraft to finance our short-term needs. Now here we can see the operating cycle. I discussed about cash, like from cash we bought raw materials converted to work in progress converted to finished goods, then receivables. And from receivables, if our average collection period is low, it can again be converted into cash. Now, factors affecting, there are nature of business. What are nature of business? Like, for example, if you are a manufacturing concern, more working capital. If you are a trading concern, less working capital. Scale of operation. If you have a large, if you manufacture 1,000 units, low working capital. If you manufacture 10 lakh units, more working capital. Business cycle. We are in boom, more working capital. We are in recession, depression, less working capital because of less demand. If we are like seasonal factors, during Diwali, during festivals, during Christmas, we require more working capital. Off season, we require less working capital. Production cycle. Conversion, like for example, to convert a samosa, we take 5 minutes. The production cycle is low, so working capital is low of dhabas. But the production cycle of manufacturing a car is very long. So that's why more working capital. Now, credit allowed. If we allow credit for more than like for example, we have a liberal credit policy, we'll require more working capital. If we have a strict credit policy, we require low working capital. Credit availed. Now, this is something what we need from suppliers. This is something what we need from suppliers. If our supplier gives us credit, low working capital. If a supplier does not give us credit, more working capital. Availability of raw materials. Now, if the lead time, if the raw materials used in my production is very easily available, that is the lead time is very low. Lead time means the time for procurement from the supplier to my manufacturing place. If that is low, then low working capital. If it is more, that is, we require more working capital. Level of competition. We have more competition in the market. We need to stand out in the market. More working capital, more advertising cost and all. Otherwise, low working capital. Growth prospects. When we grow, means we need to spend in advertisements, other thing and all. So we have to like spend a more working capital, otherwise low working capital. Inflation situation where everything becomes expensive. So input cost increases, more working capital. Otherwise, low working capital. Operating efficiency. If our efficiency is high, that is means with a lower sources, we can produce more products, more like less working capital, otherwise more working capital. Now, when we talk about the capital structure, it's very simple. When we talk about capital, I talked about formally CFO has 4 major decisions. One of those was financing decision. Financing means where to finance from. How do we get our sources of finance from? Generally, when we talk broadly classifying, finance is internal and external sources. What are internal sources? Internal sources are preference shares, equity shares, or past profits. What are external sources? Long-term borrowings from like either we can, if we are a public limited company, we can raise funds through debentures, bonds, or long-term borrowings from the bank or any other financial institutions. So what is the essence? What should be the proportion of equity and debt? Now that depends on various factors. So that factors has different things, but we have to see here right now. Now, equity in broader sense means owners fund. Who are the owners of the company? Shareholders are the owners of the company, raised by equity shares and preference shares. Now, preference shares are lesser owner, someone who doesn't have a voting right. Like in our country, we have 2 kinds of people, like major who can vote, equity shareholders. Minor who can't vote. They are all the citizens of the country, but they can't vote. They are preference shareholders. And your retained earnings is the past profit. Debt can be raised by issuing debentures, bonds, by taking long-term borrowings. Now, capital structure is a significant financial decision because it affects shareholders' return. Because we will be discussing further trading on equity, where we can understand about how to increase the earning per share of a shareholder by decreasing the number of shareholders and increasing a debt component. Means I am saying that in somewhere we take a leverage, we can increase our debt component and we can earn more profit. So that is only the objective of the CFO, increase the market price of the shares. Now, what are the factors affecting choice of capital structure? Now, risk consideration. Let's say about we already have a very high fixed cost, then I think we should prefer equity rather than debt, because debt has a fixed cost, that is interest, irrespective of profit loss you have to pay. Cost of debt, if the cost of debt, debentures or loan interest, that is higher than the return on investment, it means that we have to, like for example, we should go for equity rather than debt. Now, cost of equity. Now, if the cost of equity is high, the expectation of the shareholders are very high, it means that we should rather go for debt rather than equity. Now, what flotation cost? To raise the fund from equity shareholders or preference shareholders or debentures or bonds, we need to list our shares in the market, and we have to follow all the SEBI listing agreements and all. So that the cost of raising is called flotation cost. So if you don't want to bear the flotation cost, you can go directly to you can get a loan from banks and all, because you just have to pay a processing fee rather than any kind of flotation cost. Now, if your cash flow position is good, then definitely you can go for a debt thing, because if your cash flow position is good, you can easily pay the interest tax rate. Now, dividend, the profit, the part of the profit which is paid to the shareholder is called dividend. So if we pay dividend to the shareholder, that do not give us any tax benefit, because that is an appropriation, means redistribution of profit among the owners. So that is an appropriation. But interest is a tax deductible expense. If we pay interest, our profit will get reduced. Lower profit, low tax what we have to pay. Now, return on investment. If your return on investment is very high, that is greater than the cost of debt, you can go for equity. Flexibility. If you want to go for flexibility, that is, don't increase the number of equity shareholders. Otherwise, every time there will be an interruption, you can go for debt. Interest coverage ratio. Like for example, it is the formula for the interest coverage ratio is profit before interest and tax upon interest on long-term debt. If the ratio of such thing is very high, it means that you can pay very easily. You can pay the bank's interest very easily. So you can go for if your ICR is very high, go for debt, otherwise equity. Now, debt service coverage ratio. Now, other than interest, we need to pay the EMI principal component as well. We need to pay preference dividend as well, because there are certain fixed component. So if your debt service coverage ratio is also very high, go for debt, otherwise go for equity. Now, stock market condition. If right now we are in a pandemic, might be every IPO, I don't know why every IPO is successful right now. Sometimes IPOs are not successful during recessionary period. So you easily don't get funds from the market. At a time, rather you can get loan from the banks and all. You cannot prefer every time from IPO of shares or debentures and all. A regulatory framework. Now there are sort of regulatory framework where we should have itna percent of promoters money, itna percentage of equity shares, then we have to follow. That is regulatory. We need to follow, adhere to that. Now, if you don't understand what is the best capital structure, you can go and simply pick the successful company's capital structure of the things. Now, if you have a proper investment plan, long-term investment plan, if you have a proper short-term investment plan, if you have a proper investment plan and short-term investment plan, what you can do, let's say, you can easily have a very high profit. I can give you too many number of examples. Like for example, I can tell you, like selecting a proper capital investment, it might increase. Let's say XYZ Limited, they wanted to produce mobile. They have one option that if they select machine A, that will give us, like for example, that will help us to get the cash flow of 1 crore every year. And machine 2, that will give us a cash flow of 2 crore every year. So by analyzing how do we get this cash flow, easily we can understand which option is better. Might be 2 crore, the machine which will generate 2 crore might have a higher cash outflow. But with the various techniques, we can go and check like which is better option, right? Similarly, with the working capital thing, we need to understand beforehand. We can finalize and we can plan our cash needs in the future, so that we can understand, do we require bank overdraft or not? Because I can say one thing, we cannot run our organization without our workers. without our staffs. If you don't pay your staff on time, they will be demotivated and hence decreasing the operating efficiency. So for this, what doesn't matter, you do not get your money from the receivables, but we have to pay our staff on time. If we don't pay them, it decreases their efficiency to work. So that's why that is what how we should plan our working capital so that we can pay all our claims on time, and we should have a proper collecting mechanism so that we can collect all our funds on time. Otherwise, there will be a risk of bad debts on this. And coming towards the capital structure, I can tell you one more example. If you want to, like you might have heard about dilution of control. If I want to keep a controlling power in my hand, I should never like issue further equity shares. Otherwise, my controlling will be diluted. It will be reduced. You can go and check every successful company. You can go and check every successful company's annual report. Promoter shareholding is very high because they don't want to lose the control of the company. And some companies which are not doing good, you can go and check the promoter shareholding is very low. People are selling their stake and leaving the company very fastly. You can go and check. So this is why capital structure is important, because it was my idea, my plan was going to run the company. So I could understand where should we raise our funds from. In any way, all the three decisions should have only one goal: raise the market price of the shares so that the wealth of the shareholders keep increasing. Almost all items in financial statement are affected directly, indirectly through corporate finance decisions. When I talk about financial statements, we have four things in financial statements. That is your balance sheet, profit and loss account, cash flow statement, and notes to accounts. So overall financial health of a business is determined by the quality of its investment and financing decisions. So this is now. Over to you, Harmeet. Hi.
Hello, Bipin. That was such a wonderful session on investment and, how things fall into place. And we have a couple of questions from our students who have been listening to you. And I'll just read them out to you. First question is from Yuvraj. He says, why are financial statements of companies important and what do they tell us?
Now I'll tell you about, if you start doing anything and without knowing the end result, let's say about if we don't read the financial statement, I cannot understand about are we having profit or sustaining loss. So financial statement is the language of the business which tells you about shall we continue or not.
So it's important to analyze from time to time कि किस direction में जा रहा है.
Exactly. If we so that it is important from various point of view, because there are many users of the financial statement. Now there are internal and external users. Internal users are management who need to plan every time. Let's say about company A with the same amount of assets, same amount of capital, they are doing well, and why can't we then? So we need to analyze, do a comparative analysis and improve ourselves. And another point from employees' point of view, employees also try to see that can we grow? If organization grow, we will grow.
Absolutely. It's the growth of the organizations with the employees. Absolutely.
Exactly.
Right. Next question is from Sanam. Sanam says, what is cash flow?
Cash flow is the amount of cash which we receive after deducting all the expenses but adding back the depreciation. So little bit we have to understand about income tax as well. We according to Companies Act or Income Tax Act, we need to deduct depreciation. Depreciation is a non-cash expense. First, we find profit according to regulatory norms. Now, in that profit, you add back the depreciation. So now, what the profit is converted into cash flow. That is called cash flow.
Right.
And on the basis of high cash flow, we can, if we are having high cash flow, we can have big management. If our cash flow is lower, we cannot think of taking a debt because we have to pay debt on time. Otherwise, it will increase our financial risk.
So how is it different from a startup to a established brand and a startup? If I have to do a comparison of the cash flow, how does it look like?
Look, initially when any company is in an embryonic stage, so they raise their capital from the financing activity, like shareholders are the person who gives. But later on, after a year or 2 or 3 years, the investors expect that they should increase it through their operating capacity, through their business things. They should generate certain revenue. But after two,
Right.
3, 4 years, if you're not able to generate the revenue, it means time has come to wrap up.
Hmm. Correct.
Yes.
Correct. And what is working capital, Ishka asks?
It's very simple. Like for example, it is called the how do you maintain? Let's say about me, you have to go to the office, right?
Correct.
You need to go to the office. You need to pay a certain amount of money. Let's say about you have to spend $1,000 for going to the office,
For traveling
and for
purposes.
traveling purpose, various
Yes.
purpose, and various like you're any eating another purpose.
Sure.
Now, for the same day, you have generated a revenue of around 5,000.
Okay.
So
So I have earned
5,000 minus
4,000.
2,000. Yeah, that is the what that is net working capital. 5,000 is the
Okay.
gross working capital. That is the current
Okay.
asset what you have generated.
Right.
And the liability what you have paid, that is
Hmm.
your net working capital. Now your net
Understood.
capital is positive. You don't have to go for a short-term loan. That is credit card.
Got it. Got it. Understood. What is corporate finance? Arjun asks.
To corporate finance, I'll tell you about corporate means there are various forms of business organization, sole
Right.
proprietorship, partnership, Hindu undivided family, cooperatives, right? But they do not fall under the Companies Act, right? So there are certain entities which fall under the Companies Act. That is private limited company, public limited company, and limited liability partnership. And to raise the finance of these companies, to look after the investment need of these entities, that is the corporate finance what we deal with. How do we raise? What are the sources of finance? Where do we invest it? And where do we invest and generate the profit and give it back to the shareholders? That is all corporate finance about.
Right. We'll take the last two questions. Sapna asks, what are some sources of short-term finance, sir?
Like you can go for a bank overdraft. If you talk about on individual basis, that is credit card, what do you do? And when you talk about a company's basis, that is bank overdraft. You can go with the cash credit. These are the major sources for this short-term finance. Otherwise, there are other money market instrument also, but to that we have to get certain flotation costs. But bank overdraft and cash credit is a very popular and very easily getting thing for the short-term finances.
Right. And my last question, sir, is from Manish. Manish asks, is debt cheaper or equity? I think this is a very simple
Look,
question, but students have this in their mind. So is
now I'll tell you about if your ROI is greater than cost of debt, then debt is cheaper. Because
okay.
that gives you a like because many people think loan may you have to pay interest, so
Hmm.
hence
Hmm.
equity is a cheaper because equity people we don't have to pay anything until and unless we have profit,
So if you
right?
can tell my audience what equity is in short,
Equity means like it is a shareholders money.
right?
Basically we talk about equity shareholders. They are the real owners of the company. I told you about a kind of similar situation like we people are
Yes.
citizen of the country, right? So there are two kind of citizen. One is who can vote, one is who can't vote. They are minor people, right? Similarly, in a company, we have two kind of people, two kind of shareholders. One who can vote, they are equity shareholders. One who can't vote, they are preference shareholders. Now, their
Okay.
preference means what? It means like you get a preference over getting the return or preference over while winding up.
Right.
Hmm.
Having said that, this was Sunstone 6 trial class. Viewers, any one last message, token of message to all the students who want to establish their career in MBA in finance or who are thinking about finance? I mean, any one message to all the MBA aspirants, even the current students, one message for you.
I would say that like finance is a very great field, provided you should be perseverant, and there are various departments where you can get into finance, right? But it's a very broad field. It doesn't mean that we are going only to accounting. We have a various field. We have accounting. We have you're going to equity research. We have a field where we go into like you can say corporate. Matlab in banking, you can go credit analyst. You can go into financial analyst where you analyze. I always believe that the people who earns the most are one who analyze, because you have an ability to judge everything by seeing the balance sheet, financial statements, and these are very good profile. These are very good profile. So I can say that MBA finance is something which can give, because finance is a position which every company must have. If you go to any automobile company, you'll have finance profile. If you go to any other kind of company, you'll have finance profile. But there are certain posts which is related to industry specific thing, right? So I think we have a various things. First, you need to get over it and try to understand which field of finance you will be going over. Might be financial market side, might be financial controlling side, might be taxation side, might be indirect taxation side.
So what you're trying to say is there is a myth about the finance subject. One student, before he or she chooses his career, should sit with oneself, maybe get a counseling session from a teacher or a or a
True.
faculty or somebody, and understand where his or her interest lies. Am I
Yes.
right, sir?
Yeah, exactly. Because people think that when we get into finance, we have only one field called accounting. No, we have other field as well. It's not only accounting. We have other field. We can get into banks. We can get into NBFCs. We can get into many consultancies, right? Where we have assurance services, where we have accounting standards thing. We have to like look after the accounting standard, and there are various accounting standards nowadays. The people like we are getting outsourced job, Accenture and all, and we have various one accounting standards per department only. So
Right.
there are various fields.
Right. Thank you so much, Bipin sir, for joining us today and making the Sunstone Trial Class episode 6 a success. Thank you so much, sir.
Thank you.
Thank you. So this was Bipin sir with us, a faculty at Sunstone University in finance. And we learned so much about finance and the way things happen. And if you want to develop a career in finance, now you know how to go about things. It is your career. It is your duty to research on things, right? So this is all about today's trial class. Do not get disheartened, our lovely audience. We will meet you again with another insightful trial class next week, which is Wednesday at 2 p.m. And of course, the Industry Expert Talk series, which is going on this Friday, again at 6 p.m. we meet. So stay connected and keep following us for more updates on webinars, interesting videos, and content that can make you grow in your career. Also, we do Sunstone trial classes every Wednesday, as I said, at 2 p.m. and Industry Expert Talk series every Friday at 6 p.m. Thank you for joining us again. This is me, Harmeet, signing off.